Hey everyone, welcome back to the channel. Today I want to talk a little bit about the efficient market hypothesis and a very interesting case study that just came to my attention via David Einhorn and then CNBC, who was talking about his little comment he made about Hometown International Inc., which is a New Jersey-based deli. I'll get back to that in just a second, but first I want to talk about what the efficient market hypothesis proposes is the case in the stock market. The central argument of the efficient market hypothesis argues that stock prices reflect all available information, and by extension, no one can really have an informational edge because all the information is baked into the stock price. Because of this, it should be theoretically impossible to beat the stock market over the long term. Because prices are efficient, you don't have an edge, you can't have an edge because all available information is already in the stock price. Already that conclusion should be sounding some alarm bells, since you have notable examples, perhaps the most notable being Warren Buffett, who has beaten the market for many decades, and there are many who follow a very similar approach to him who have done the same thing in valuing companies and getting them at a discount. At least that's the approach we're trying to take. And they continually beat the stock market. And there's always at least a group of people who are continually beating the stock market. So what gives? If everyone's investing efficiently, we have all this efficient information, what's going on? And another really obvious counterpoint to the efficient market hypothesis is insider trading. When insiders have exclusive information that they aren't supposed to trade on, but they actually do it, obviously that's illegal, but isn't that an inefficiency? And we have these laws that try to combat it, but ultimately you're never going to combat all of it. Some of it is going to slip through and people are going to be harmed. But I think the real problem with the efficient market hypothesis is how people use it and how they assume that it's impossible to beat the market and that stocks are priced efficiently somehow. Now, I would agree with stocks in particular. The markets are efficient in that the price that you see is the price that you're paying. It's not as though it's something like a real estate deal where you can actually get something well below market value and the thing is objectively able to be sold for more that same day. Whereas with a stock, you aren't going to be able to get some sort of undercut price without some sort of option or something, but you're paying for that, so that would still be efficient in that sense. So I think the stock market is theoretically more efficient than something like a real estate market where you can do things off-market deals, for example. It's very difficult to do that with stocks since you can't get anything below the price that is currently listed on an exchange in just about any case, at least with publicly traded stocks. So I guess you could say it's fair, but I wouldn't really call that true efficiency if we're talking about accurate valuation, since the fact that the stock market is efficient in that sense doesn't necessarily mean that valuations are actually going to make sense in themselves. And that brings us to the subject of today's video, Hometown International Inc., a New Jersey-based deli, which currently has a market cap of around $100 million. It has traded down a little bit today, down to $91 million in valuation. Now, on the surface, you might think, okay, great, $100 million business. Maybe they're doing well. They have a bunch of locations and they're selling a lot of sandwiches or something like that. Well, the answer to all those questions is pretty much no. One of the first things I like to look at with a company is their statement of cash flows to see how much free cash flow they have at the end of the day, since that's the lifeblood of any business. That's what can be used to expand the business, pay shareholders, all the good stuff that you'd want to have. If you don't have any cash flow, you're not going to survive for very long as a business. Sure, you could be propped up with debt and all that stuff, but that's temporary. You can't do that forever. What if we look at Hometown International's? It looks like they lost over $500,000 last year. That is $668,000 they lost in 2020. 2020 obviously being a brutal year for restaurants in general, lots of closures. They're in New Jersey as well, which had pretty harsh lockdown restrictions if I'm not mistaken. But if we go back in time a little bit and look at 2019, 2018, they were losing money there too. They lost $150,000 in 2019 and lost $50,000 in 2018. So the business is becoming more and more unprofitable as we move along in time. And they started publicly trading for some reason back in 2019. But you can't just look at the cash flow. Maybe they have a stacked balance sheet, tons of cash. It's really just a holding company perhaps. Let's take a look at that. If we go over to their balance sheet, oh wait, they don't have a ton of cash. All they have is about $1.4 million and pretty much no debt. So we're talking about $1.4 million, a restaurant that's hemorrhaging a ton of money, and that's it. And that has earned the lucrative valuation of $100 million, or about $90 million today. So people bought the stock today at that price, at a $90 million valuation. It doesn't trade very much. It's on the over-the-counter market, so it's not nearly as liquid. But this valuation does reflect all the currently available information that they're losing a bunch of money and that the sandwich shop is not profitable and they don't have a ton of cash, yet they are still getting this valuation. This is just an example of what I'm talking about with the fact that just because the market is quote-unquote quote efficient in that the price you pay is the price you're seeing on the screen, that doesn't mean that the valuation itself is actually reasonable. Efficiency does not equal reasonableness, at least in this world. But you might say, Jack, this is a lame example. There's only 60 shareholders according to CNBC on this company. I didn't look too much since I don't see how a single sandwich shop can garner this sort of valuation unless they're bringing in an insane amount of money, which this company is only losing it at the moment and have been for their entire publicly traded history. But you could point to a lot of examples where, sure, everyone had the information available to them, but they still seem to make pretty stupid decisions. You might recall the news about a year ago about Zoom Technology stock when it surged on the news that it looked like people were going to be staying at home for a very long time and we're going to be using Zoom, the actual video platform, but people were investing in Zoom Technologies thinking it was Zoom, the communications platform. But that is actually Zoom Communications stock, the ticker symbol ZM. Zoom Technologies, the not video call service, which is actually it was like a Chinese tech company of some sort that wasn't even operative, that had the ticker symbol ZOOM. So people thought, oh, Zoom, that must be what it is. So they bought it, but all that information was available to them if they spent 5 seconds looking at it. But the average investor doesn't do that. The average investor invests on emotion and feeling, and that's hard to call it truly efficient or at least accurate. So yes, all that information was available to them. They could have known very easily that they were not actually investing in Zoom Communications. They were instead investing in Zoom Technologies. Yet they still made the investment decision anyways, and that affected the share price in a huge way. I think Zoom Technologies, if I look at this article, yeah, it was up 47,000% on the year, and it doubled in one trading session or something like that. So the efficient market hypothesis would say all these investors had the same information available to them, and therefore the pricing was efficient. It's kind of hard to argue that that pricing is accurate and that the company is actually worth that amount based on the fundamentals. And sure enough, shortly thereafter, Zoom Technologies fell in price, and a lot of those people who bought in that day thinking they were buying one thing ended up losing money. Now, if we look at the Hometown International case, yeah, sure, they're not really going to be able to liquidate at $90 million since they need to find enough people who would pay that liquidation value for the company if they were trying to cash out everything. But no one's really going to do that, at least I would think. But again, you can't really put it past people since people make some very strange decisions, especially in times of euphoria, where they're trying to make a quick buck, where they're speculating, where they make ridiculous decisions like this, like buying a share of a sandwich shop that is currently hemorrhaging money at a $100 million valuation when it has nothing close to that in revenue, profit, or even cash on its balance sheet. Now, am I saying that you should become a stock picker tomorrow because you can beat these stupid people and you know how to value companies? Well, no, not necessarily. It might make a lot of sense to do passive index investing and just take market returns over the long term. That can be very lucrative. It's very simple to do, very simple to execute, and doesn't require all the work of doing due diligence and being super patient waiting for a deal on a company. It's very similar to real estate investing, where you're looking for a good deal. You have to be very diligent. At least this is the approach I take. You can do whatever you want. It's not financial advice. But just because the market is saying that this is the price, that doesn't mean that over the long term it's going to hold that value. What it's valued may be very different from what it's actually being priced at. For whatever that means, that might be kind of confusing. But I would argue for sure that the intrinsic value of a company often is not the same as the actual market value that it's trading at in the short term. But over the long term, you see a correction towards the actual performance of the company being what determines valuation, as opposed to wild speculation or mistakes in this case, and otherwise just strange occurrences like this Hometown International example. I would not expect the stock to hold this valuation forever since the business performance simply doesn't justify it. There could be something else going on here that I don't know about, and that's not very efficient. We're missing information in that case. So I don't know what's going to happen with this stock. No one knows the future, but it does seem like over the long term, company valuations typically are based on business performance over the long term, and if the company doesn't meet the valuation that people were saying that they thought it was going to meet, then it's going to lose the stock price, it's going to lose value, and you're going to run out of money when you're investing in overpriced companies. The hardest part is finding companies that are not overpriced based on your risk tolerance and then going for those. It takes a lot of patience, time, due diligence, and of course, discipline, since even a fairly valued stock might suddenly do weird things with its stock price in the short term. Same sorts of things can happen to many different stocks. You never know what the market's going to do in the short term, but you got to have that long-term perspective to figure out, okay, I'm investing in this company at what I think is a good price. I'm going to hold on to it. If the company fundamentally changes, okay, maybe you reevaluate your position and decide whether you liquidate or not. Or maybe the company has a huge run-up in its stock price and now it's trading way over what you think it's worth. Might be time to sell. That's the approach I take with investing. It's not necessarily the best one for you. It depends on what you're doing, but I'm trying to get something at below its intrinsic value to where when it actually reaches that intrinsic value in the long term, I'll be able to make a decent profit. There are other ways to make money in the stock market, of course. Some are more short-term focused. Some are also long-term focused. That's simply the approach I take. You can do your own research and figure out what works for you. But in the meantime, wow, that is an expensive deli. And if you still believe in the efficient market hypothesis and you don't believe that you can actually beat the market with any reliability, at least over the long term, okay, that's fine. All I'm asking is that people look at these theories, especially these broader theories, with some critical thinking. I know that's a buzzword that a lot of colleges like to use, but try to look for counterexamples. See whether this theory can actually hold up on its own, and then you can make decisions from there, and hopefully they'll be even better for you based on your investment preferences. Don't take any theory as fact or doctrine, including my own. It doesn't mean that I'm necessarily right. What you should be doing is trying to figure out which one is best for you, and that can be based on a variety of circumstances, and all you can really do is look at the world around us and what's actually going on and try to make conclusions from there. But that's all I've got for today. If you like this video, please like it, since that would help the channel out a lot. I put out new videos every single week as they have to do with investing and personal finance, so if you like that sort of content, be sure to have a look around the channel, and if you like what you see, be sure to subscribe. But until next time, take care.